For documented episodes in history share a common structure, a government or monetary authority tightening credit or monetary conditions into an already slowing economy. In each case, the historical record shows the same sequence of outcomes. This is the archive. Episode 1. Rome under Diocletian. 291 to 301. The Roman Empire of the late 3rd century faced a combination of fiscal pressure, currency debasement, and economic contraction. The silver content of the denarius had fallen from approximately 90% under Augustus to less than 1% by the reign of Gallienus, a debasement that had produced inflation throughout the empire. Diocletian's response involved two tools that, historically, have compounded rather than resolved the underlying problem. First, monetary reform. A new silver coin, the Argentius, issued at a fixed rate. Second, the Edict on Maximum Prices of 301, a comprehensive price control applying to more than 1,000 commodities and 100 categories of labor. The edict fixed maximum prices and penalties for violation, including death. Goods disappeared from the formal market. Barter expanded. The monetary tightening and price controls together produced a contraction of formal market activity that historians of the Roman economy have documented through both literary and archaeological evidence. The edict was effectively abandoned within a generation. Episode 2. The Ming Dynasty. 1436 to 1440. The Ming Dynasty had operated an extensive paper currency, the baocow, since the early 14th century. By the 1430s, the baocow had lost most of its exchange value through inflation. The dynasty's response was effectively a monetary tightening. It required tax payments in silver and copper, withdrawing the paper currency from official use. The shift created a deflationary shock in regions where silver was scarce. Agricultural prices fell. Tax obligations payable in silver put pressure on subsistence farmers who had no access to silver markets. The transition took 4 years of documented economic disruption and contributed to fiscal instability that persisted through the mid-15th century. Episode 3. The Ottoman Empire. 1620 to 1625. The Ottoman silver coinage, the aksi, had been debased through the late 16th century in a manner structurally similar to Rome's denarius debasement. By 1617, the aksi contained approximately 1/3 of its original silver content. Inflation was severe across documented price series for grain, meat, and cloth. The response involved tax increases and attempts to enforce payment in full-weight silver, into an economy already contracting from trade disruption and military costs. The Salali rebellions of the early 17th century, while multicausal, coincided with the period of fiscal tightening into economic weakness. Episode 4. The United States Federal Reserve. 1929 to 1933. The most documented of the 4 episodes. Following the crash of October 1929, the Federal Reserve allowed the money supply to contract by approximately 1/3 between 1929 and 1933. Over the same period, 9,000 banks failed. Nominal GDP fell by nearly 50%. Unemployment reached 25%. The Fed's rationale combined gold standard constraints, the fear of gold outflows if rates were cut, and a liquidationist theory that argued the contraction was necessary to clear excess from the economy. Both the constraint and the theory have since been rejected in mainstream economic history. This is now the textbook case for what a central bank should not do in a deflationary contraction. Milton Friedman and Anna Schwartz's 1963 work documented this sequence in detail. Ben Bernanke's academic career was built in part on this literature. The common sequence across all 4 cases, monetary or fiscal. Tightening into a contraction produced documented worsening of the contraction. The severity tracked the speed and magnitude of the tightening. Historical commentary only. Not a forecast. Not investment advice. Speak to an authorized financial advisor before making any financial decision.